Ever stared at your Peachtree accounting software and wondered why your account beginning balance is showing up as a big, fat negative number? That negative beginning balance is usually signaling a problem, not the end of the world. It tells us that something wasn't quite right when we set up our accounts or during prior accounting periods, and it throws off your current financials. One very common reason is an incorrect initial entry. This happens when the initial balance you entered for an asset, like cash, was entered as a credit instead of a debit, or vice versa for liability and equity accounts. Simple data entry errors can also be culprits if previous transactions haven't been entered accurately. Like accidentally doubling an expense. Another problem may be failure to reconcile your bank statements properly, which can then lead to discrepancies between what your books say and what's actually in the bank. And finally, incorrect setup of your chart of accounts will definitely result in negative beginning balances. So, how do we fix this? First, meticulously review your beginning balance entries in Peachtree. Go back to your period where your company's records began, typically your company start date, and trace the initial journal entries. Make sure assets truly have debit balances, while liabilities and owner's equity have credit balances. To change an entry, you can go back to the general journal where you made the original entry. Just be careful when editing old transactions because this can change prior reports. Let's say you initially entered $5,000 as a credit to your cash account when it should have been a debit. The correction: create a new journal entry debiting cash for $10,000. This will remove the unnecessary credit balance and correct the original cash balance. Then make sure to reconcile your bank statements regularly. This process helps find those data entry errors, like missing transactions. Fixing these errors will clear up a majority of beginning balance problems. Getting your beginning balances right is absolutely important for accurate reporting, decision-making, and overall financial health. It will save you time and headaches in the long run. Remember, accurate financial statements rely on a strong foundation.